Hi CA students, let's revise CFA and AFM Chapter 6 Portfolio Management Illustration 6. The following information is available with respect of JK Limited. Year is given and JK Limited average share price and dividend per share is given. Markets average index and dividend yield is given. Government on return on government bonds also is given. They are asking beta value of the company as at the end of 2005. What is your observation? Now we have the data of JK Limited. Using that we can find the returns of JK Limited, and then we have to find the return on market return also. Then we require expected return on the market also and on the stock also. Once we got the expected return, and if we apply it in this formula, we'll get the beta. So this formula is nothing but finding out the sensitivity of two assets, how one asset is sensitive towards the other. In our case, XY signifies those two assets. X will be our return, and Y will be the market return. So how X is sensitive towards the market return, which is Y. So this the sensitivity is the beta here. Sensitivity of the stock towards the market return will be the beta here. Okay. Before finding out the expected return, we need the actual return for 2-3 years to get the expected return in both the cases. As we have the average share and the DPS, we can find the return in each year, then we can find the expected return. In the case of JK Limited, the dividend per share is 20 and there is a capital appreciation in every year. Since the data starts from 2002, we'll take for 3 years from 2003 to 2005. So in the year 2002 to 3, the dividend per share is 25, which will be the return, plus there is a capital appreciation of 279 minus 245. Adding with the dividend of 25 and dividing it by 242 will give us the return for 2002 and 2003. Now going further with the same way, we will get the return for the upcoming years, wherein the dividend is 30 plus 305 minus 279 divided by 279 will give us return on 2003 to 4, and same case goes with 2004 to 5. Same way, markets index also has been increased, so there is a capital appreciation there, and DPS has not been given as market consists of many stocks, so the yield is given for market dividend yield. So we have to find out the capital appreciation percentage, and then if we add it with the dividend yield, we'll get the return of the market for the respective year. In our case, for 2002 to 3, it is 1950 minus 1812 divided by 1812 will give us appreciation, index appreciation. Along with that, if we add dividend yield, we'll get total return, which is 12.62 in first year, in 2002 to 3, then 3 to 4 it is 21.79, and 2004 to 5 it is 5.32. Now we know the returns of JK Limited and market index. Now keeping JK Limited stock as X and then market as Y, we can find out the expected return, which is nothing but X bar, so which is a mean return average, simple average 62.74 divided by 3 will give us the expected one, mean average, and then y bar 13.24. Substituting in this formula will give the beta, which is 0.15. As we can see, x is less sensitive towards market return since it is less than 1. So the question is asking our observation also, so we have to write the point. Based on the beta value of the company and the analysis of returns, it can be concluded that changes in the return on share of JK Limited are less affected by changes in market returns. We can also mention that since the beta is less than 1, it is less sensitive. If the beta is more than 1, it will be more sensitive. Thank you.